Hey everybody, Smart Silver Stacker here. Hope everybody watching is doing well. Got a guest on the channel today. Very excited for this. It's James Anderson. So James is an analyst in the precious metal space. He's an expert in the physical side of bullion investing. And you can see some of his work every week over at the SD Bullion YouTube channel. And I personally have been following James' work for many years now. So very excited to get a chance to sit down with him and have a conversation about what's going on in the physical precious metal space, because there's a lot to talk about. So thank you very much for joining us today, James. Excited to have this conversation.
Great. Thanks for having me on. Excited to be on the channel.
Absolutely. So let's just get right into it. There was a tweet from Nikki Shields a couple weeks ago. She was at the LBMA conference in Lisbon. And in that tweet, she said that the participants in that conference were mildly bearish on gold for 2023, but they were very bullish on silver. And she published a price target in that tweet of $28.30. Now, for the past 6 months or so, since the Fed has been hiking rates, we have seen a falling silver spot price, rising premiums on silver. And it seemed for a while there when silver was near the lows, maybe around 18 bucks or so, that interest in the physical precious metals and sentiment, I mean, I saw it in the comments on my channel. I'm sure you were kind of observing that as well, was down. But now we've seen Nick Timiraos, the Wall Street Journal chief economic correspondent, also known as the Fed Whisperer. He's kind of floated this idea of a soft pivot by the Fed. So a slowdown in the pace of the rate hike starting in December. And we're starting to see some interest in physical bullion pick up in a big way, and that's being reflected in these higher premiums. So what are your thoughts on a Fed pivot, a slowdown? If we do see that, how would that affect the spot price of silver moving into 2023? And also, what effect do you think that would have on this premium situation that we've been observing?
Right. So this year, really what's been driving the markets mainly has been a resurgence of the relative Fiat US dollar bull market versus other currencies on a relative basis. The US dollar has been gaining strength versus, for instance, the Fiat British pound, the Fiat Japanese yen, the Fiat euro. All three of those are major FX trading fiat currencies. They're used a lot in investing and such. So, depending on where their demand and how they're valued versus the US dollar, depends a lot on how capital flows are going, and also depends a lot on how their denominated gold and silver spot prices are. But when it comes to your average gold and silver price and the charts in general, the Fiat US dollar gold price is what drives mainly the gold price around the world. There can be changes that bifurcate from one another often, depending if a fiat currency is going completely, up in the air in terms of value. But for the most part, that's what's really driven this sell-off this year in precious metals, and you've seen that across the commodities complex in general. It's because the Federal Reserve has been tightening interest rates, and there's this silly notion out there that somehow this is going to squash inflation. And even the expectations of the long-term expectations in the next 2, 3, 4, 5 years of how inflation is going to run. A lot of people expect that inflation is going to go back down to 2 to 4%. And yeah, it's possible if we go through a major recession that happens, but it's going to be driven by a recession, not because the interest rates are getting to 4 and 4.5%. So this is a lot of financial propaganda that you have to listen to, and a lot of capital movements, because there's only so many places to go when you're huge in terms of an investor class and the amount of capital flows. They really don't have that many options. I mean, the gold bullion pile physically in the world that's ever been mined is maybe 11 to 12 trillion notional in value physically. And the derivatives complex is obviously much larger than that. But I mean, there's only so many places to go, and you're talking about hundreds of trillions out there that's seeking a safety and a place to be that can fight inflation. So it's a long answer, but the bottom line is yes, the pivot is going to happen. The question is exactly how it'll come about. They're already signaling it. You've got, I think Biden today put his foot in his mouth, said something along the lines of he endorses the pivot. I'm not even sure if he knew what he was saying. I mean, it was that I saw the tweet before we got on here, and it's just funny when someone gets confused on what type of financial propaganda they're supposed to be saying.
Right. Yeah. I don't know that he has too many original thoughts on the state of inflation and the Fed's policy. I did read today that Elizabeth Warren sounds like she's getting pretty aggressive at criticizing the Fed, saying that these rate hikes are putting working class Americans at risk. And it seems like if we do see a big increase in unemployment as a result of this rate hike policy, which ultimately, like you said, these hikes, they're not going to be capable of fighting inflation unless it's through demand destruction, right? Unless they just utterly gut the economy. That seems to be the only way that they'll get inflation under control. You mentioned the rising value of the US dollar and how that is affecting the international economy. And I saw in a recent video that you put out on the SD Bullion channel there about how Indian silver imports have been increasing as of late. And another thing that we've been seeing is a high premium on gold in the Shanghai market and also in Turkey. So in Turkey, a lot of it has to do with rampant inflation. So investors are moving into bullion as a safe haven because, gold and silver typically do function as inflation hedges. And a lot of people get, that twisted sort of that because they're not rising in terms of US dollars, maybe they're not actually an inflation hedge. But, if you look at the chart of gold and silver in the Turkish lira, clearly, it is doing its job of protecting the purchasing power of investors over there. But what do you attribute this flow of gold and silver from west to east to? Is it, just inflation concerns? Is it perhaps something to do with the weaponization of the dollar and these sanctions? And so countries are looking for alternatives to the dollar. I'd love to get your take on what is causing this flow of metals from west to east.
So it's a common thing in the gold market, and then we saw it in the mid-2010s after the 2011 highs for gold and Fiat USD. In August 2011, it peaked at near 1900, and then rolled over by the end of 2015. It got down to 1050 an ounce. Okay, so that's a huge drop. It's almost 50% it went down. During that time frame, you had China, who was buying massive amounts of gold, and when you look at overall how much gold flowed out of Western ETF sales. A lot of it was people who had GLD or IAU and this or that. The unsecured ETFs where they have shares in them, and when they sell them, those ETFs then have to take the gold bullion that supposedly backs that ETF and figure out a home for that gold because they had net sellers for years and years and years. And we've been having that recently a lot too. Western ETF holders of say SLV or GLD or IAU have been net sellers since pretty much since basically 2021 into this year. And so what you've seen is a lot of silver and gold flowing out of both those various unsecured ETFs silver was headed toward India mainly. And then you have a lot of gold that's headed to places like Turkey and China because the combination on the local side of those markets, they know inflation is always there. So they use it as a historic store of value. And then B, on the local currency front, if it drops in value, they buy the dip. And so you have a situation where you have a price dip in the yuan Chinese gold price, and they're getting out of COVID and they have some savings. They go and buy gold. They buy the housewives of China consistently buy gold jewelry when there's a massive dip in price. They did that in 2013 on a huge scale, and they're doing it now in some way, some form, some fashions. But the Indian story is the most important thing I think that's happened this year because you're going to end up having India import over 300 million ounces of silver alone this year. And, the estimates from Metals Focus, the guy was on TV just this past week in India, and he said, it's conservative to think that it'll hit 10,000 metric tons. So 10,000 times 32,157, that's 321 million ounces to India alone. That's a third of the entire annual silver mine supply going to one country.
Yeah, global production is under 900 million ounces, right? So that's a tremendous portion of annual production. And, some needs to be saved for industry and that sort of thing. Now, how much of that is investment demand and how much is, for industrial purposes? Any insight into that?
It's a combination of mostly store value demand, which is bullion and or jewelry. A lot of farmers will buy silver, in between cycles of farming, and they'll use it as their savings or they'll speculate in the market. I mean, India has a long history of people buying physical gold and silver. They've gone through massive amounts of currency debacles where currencies go up in smoke. They've got a CBDC grid that's getting launched currently. The Fiat rupee CBDC is getting launched, I think today, just as I saw the news. So I think a lot of them on the gold and silver side understand that, and they look for a store of value that's kind of outside of the privy of central banks and such. And they just don't trust the banking system. They don't trust their government, and understandably so if you look at their history over the last millennia. And then the other thing is in terms of, basically in terms of them and their interest, it's also the fact that silver is much lower in fiat rupee price than gold. And gold is typical. Gold is becoming unaffordable, unattainable to the average, Indian person who's looking for a store of wealth. And when they look at which is better value right now, and they look at the charts, it's pretty easy. If you look at a long-term chart, you can see gold doing this move and silver just kind of lagging in a cup and handle. And so typically silver follows gold. And so that's a lot of the speculation going on too.
Yeah, the gold to silver ratio where it's at right now, I would tend to agree that silver is the better buy than gold. And, we are seeing premiums on both gold and silver products shoot up. And to that end, speaking of this flow of gold and silver, out of Western inventories, we've been seeing the COMEX and the LBMA, their inventories of silver dropping dramatically over the past several months. And, I want to ask you, get your take. What happens if they run out? We saw in April, the LBMA, the nickel market got squeezed following the Russian invasion of Ukraine. And what they did then when there was a squeeze in nickel was they froze the market, to save their billionaire buddy, Zhang Guangda, the Chinese nickel magnate who had this tremendous short position. And so they kind of punished the longs who weren't able to take profits on their, correct position. And they did that to bail out their billionaire buddy. Now, nickel, obviously a little bit different than silver and gold because, nickel's a little bit harder to take delivery of. You'd have to, store that stuff in a warehouse. Like, was it Kyle Bass? He has that giant warehouse full of nickel, but that's beyond your average investor, I think. So what do you think that looks like if their inventory levels decline? Because I think that's a real possibility with how low they're getting and with a potential interest in precious metals rising. I mentioned in a video that I recently put out, the total value of the COMEX deliverable silver is under $4 billion. And that's just not that much money in 2022. All it would take is a few serious investors to come in and buy that up. When you compare it to the market cap of, say the S&P 500 or any other metric that you compare it to, it's just not very much silver. So what do you think that looks like if that gets cleared out? What'll be the reaction?
So COMEX, in its own rules, it's basically, think of COMEX as its own casino, and it's mainly a leveraged derivative market where the leveraged derivatives are what dictates what's happening with the price action. There's only so much physical that actually gets delivered. That's warranted, that actually, someone goes in and takes 1,000 ounce bars from. It's a minuscule amount, though it's growing, the amount of people who are taking delivery. And like you said, it's been going down a lot. When you look at the number, there's about 300 million ounces between registered and eligible. Registered is the warranted pile, the one that's up for delivery, that possibly could be physically delivered. I think that's at 35 million ounces. And the eligible pile's around 265 million ounces. Eligible pile is the stack of silver that's not warranted, so it's not up for delivery. And when you actually dig into what that is, it's half of it's roughly, ETFs. So SLV has a major chunk of it that's sitting in New York with JP Morgan. And then you look at it, and I'm not saying this, it's CME Group, the owner of the COMEX, that actually did this study in February 2021 because they were scared, very scared about what was going on with the silver squeeze kickoff at the time. So they were trying to do a study about what amount of that eligible pile could actually be physically delivered in our system. What's the guess? So they went around, they talked to a bunch of industry players, and they came back with 50%. 50% of it can be delivered, right? So you look at the numbers, and so you're talking about you just extrapolate those numbers now, and you're talking about 165 million ounces. The rest of it's probably never going to be delivered. And so 165 million ounces effectively what backs this entire COMEX thing. And the LBMA is now at record low levels. It's down near 800 million ounces. And if you look at the correlation between the amount of Indian silver imports in the last year and a half, the record clip that's been going on, and you look at how that's been going up, and the London silver has been going down, put two and two together, it's going to India, right? And so the question then becomes, well, what happens? I mean, you end up having this situation where it's force majeure, you get paper settled, you get settled in dollars, you get settled in SLV shares, you get settled in GLD shares maybe. That's basically it. You end up having these paper proxy, trading systems where, don't get me wrong, they'll probably still push price around a lot of times. But what you'll end up having is people, momentum longs who are greedy, who want to make money, will come into those markets and they'll bet long and they'll win. They'll take the shorts for a long ride. This has happened multiple times in commodity market history. It happened 1976 to 1980. Gold went from 200 to start 1975 when the COMEX opened. It got cut in half to 176 summer, and it ran to 800 by January 1980. That's an 8x. It happened after the U.S. Civil War in the supposed gold, phantom gold market. You had a situation where, the greenback was out there, and there's a supposed conspiracy amongst the guy who's working in the government with his brother-in-law. Then they basically used phantom gold, which is another way of saying derivative gold. And the price of gold ran from $20.67 to $163 in a short matter of time. Another 8x. So an 8x in gold is something that can happen and likely will happen with the amount of energy that we're pushing underneath the system and the amount of interested parties. I mean, today you just saw a report that central banks are buying at a clip now in the past year that has not been seen since 1967. 1967 was the year right before the LBMA, the London gold pool failed, essentially. So, I mean, the governments are buying the dip. The Easterners are buying the dip. I mean, do you not get it? I mean, it's basically really simple. They know history and they understand a discount when they see it. And so they're doing it right now when prices are discounted.
Yeah, it's very interesting. You mentioned that document from the CME group, that survey they conducted. I was taking a look at that the other day, and they floated out this 50% number, like 50% of our eligible silver is probably deliverable. But in that document, they did mention that the surveys that they sent out to try to determine how much of that silver was being held as a long-term investment were inconclusive. Yeah. So, it might be 50%, right? But it could be less. This is just kind of a ballpark estimate by them. And, another thing you mentioned there, the 8x run up that we saw in the late 70s, it seems like, I don't like to get too pie in the sky with forecasts or anything. I don't have a crystal ball. I can't forecast anything as far as price too accurately. But a major difference between now and the 70s is that, in 79, Volcker was able to crank up the interest rate to 20% to get inflation under control. And it was just after that we saw gold and silver peak. But these days, a big difference between now and then is that debt to GDP ratio in the US was something like 35% back at that time. And now it's almost 130. So it seems like the Fed is going to be a lot more limited in their ability to raise rates. So, I mean, it seems like potentially an even bigger increase in the price of gold could be in the cards. What do you think about that?
Yeah, no, it's totally agreeable in the sense that people always point to the 1970s because of the ongoing inflation and the supply crunches, et cetera, et cetera. But the truth is we have a confluence between the 70s, the 1940s, the 1930s in terms of what's going on. So this time is going to be similar in a lot of ways to all those different eras, but they'll rhyme in different ways and they'll all be a confluence of it. So how it's going to go, how it's going to play out, a lot of it will probably be, it's very difficult to know, but you end up having a situation where, governments are obviously looking after themselves and their surplus savings, and they're buying gold hand over fist at a clip since 1967. What happened a few years later, 1971, and a default in the U.S., Bretton Woods system. So essentially, you have a situation where, a handful of years out in the distance, you got to have a major situation where all of a sudden the rules change and gold gets revalued or repriced to a much higher, what I believe would be a much higher value. I mean, it's I'm not trying to throw out wild fiat dollar denominated prices. Really what matters is what it's going to buy you in terms of real value versus goods and services versus asset classes. And gold to me is going up in the future based on all the various factors that are at play at the moment.
Yeah, if you look at any of the historic ratios, certainly relative to stocks or relative to real estate or relative to just about any other asset class, gold and especially silver right now are very cheap on any kind of historical basis. Like you said, throwing out a fiat dollar price target, it may get to the point where that just becomes irrelevant because, the dollar is an aging fiat currency kind of getting towards the end of its life cycle, potentially. I mean, it's, we've seen as the rates have been hiked up, the investors have moved into the dollar. It's still the world reserve currency. It's still perceived as a safe haven, but that can change pretty quickly. And certainly there's a lot of moving parts right now, but I agree. All of that, it's hard to forecast what's going to come, but it's not too difficult to see that, being in a real tangible asset without any counterparty risk in this kind of a situation is probably where you want to be. At least that's my take on it. Of course, I got to throw it out, not financial advice. We're not financial advisors or anything like that.
There's two things to throw in there too. You got to remember too, the speed of communication and the internet and what that can do psychologically to groups and masses. The speed of the confidence failure in the store of values around the world. Those are all things that I don't think people are fully calculating or we even know. Secondly, the other thing is the BIS is working right now diligently the last few years on quick settlements internationally between countries, direct CBDC trading. And so essentially, if you create a grid where governments are going to be able to trade with one another and settle with their own fiat currencies direct, there's going to be no USD in the center of that, right? So you're going to end up limiting the amount of US dollar demand in the future. It's going to handicap US dollar. And ultimately, it's in the government's interest. They're going to lie all the way through it. You're going to see the sky is blue, and they're going to tell you it's black. Okay, they're going to tell you all these things that aren't true. You're going to be living in a situation. If you talk to anyone who lived through the failure of Russia, nothing was ever said true from the officials. It was all a lie, and it was like this crazy situation where it was very difficult to listen to anyone who was supposedly an official because you just felt like you were going crazy. It's similar to that, but it'll probably happen in a slower motion, hopefully, and not be some type of wild hyperinflation. But that potential does exist, and it's very scary and it's risky. And the speed of technology, that's the thing that you have to really think about. Is the BIS CBDC grid, what's that going to do to the world? What's the CBDC grid going to do inside of countries in terms of privacy and people's ability to have stores of wealth that are outside of the system? All these things are important to think about, and these are things that are going to be changing vastly in the next 5-10 years.
Yeah, the global trend towards de-dollarization seems to be pretty firmly in place. I mean, we're seeing more bilateral trade agreements between countries, the dollar getting edged out of these trade agreements. And, even now we've got Saudi Arabia talking about how they want to join BRICS, right? So, I mean, there's all these risk factors for the dollars out there. I do kind of want to bring the conversation back to the premium situation, because I know you're an expert on the physical side of the market in particular. So, silver premiums, we've seen them going up dramatically. Even a 1 ounce generic round, something that you used to maybe get for a few cents over spot is, $5 over spot now. But we haven't seen this anywhere as much as in US Silver Eagles. I mean, they're 100% over spot now, if you're lucky. And I mean, what is very interesting to me is that the dealers, the online bullion dealers, are buying these things back now for $10, $11 over spot, which, I mean, that's wild. If you think about it, the sell price being, that high over the spot price. Now, we haven't seen premiums on US Silver Eagles this high since the 2008 financial crisis. And I know you've been involved in the market since then. So I'd like to get your insight on, what kind of a time frame we might see these premiums potentially come back to, quote unquote, normal levels. Do you think that will even happen? And before that happens, do you think that they could go higher?
Yeah, so I cut my teeth in this industry in 2008 in the fall of the global financial crisis. So basically from August to December, and basically those months were hectic in this industry. There were days where we didn't have any silver inventory and we barely had any gold inventory. And so you had a situation where, I don't know, dozens of banks in the United States were failing. Every other day you hear about a bank that's failing. I mean, so you had people on the phone that were completely concerned, and rightly so, that what they had in the bank wasn't going to be there. And so they'd rather have it in bullion. And so they were buying hand over fist. And it wasn't driven by greed, it was driven by fear. And that's much more powerful of an emotion when it comes to bullion. Ultimately, right now, you have some of it is fear driven, some of it's greed driven as well. You get both that combination in gold and silver on both sides. And I'm sure you've heard it countless times in your comment section. But the truth of the matter is that this is going to be a fear-driven, ultimately, market. And it's the Western world that's ultimately going to be fearful because their stores of value will be working. And that's really what's going to end up doing this. It's going to be the Western world, powerful, large flows of capital that will actually flow into this sector in big waves. And this sector is so tiny, it won't take much to make this sector, multiple in many ways. And so, yeah, so when you look specifically at the Silver Eagle, you have to kind of think in terms of the history of the Silver Eagle. Basically, it's dysfunctional now. In 2010, the Dodd-Frank Act, they basically amended the original 1986 Silver Eagle and Gold Eagle Act. The original act said that the U.S. Mint was charged with creating the Silver Eagle and the Gold Eagle in order to sufficiently meet public demand ongoing. And they amended it and said, well, now that in 2010, they claim, now the U.S. Treasurer, head of the U.S. Treasury, is going to determine and state what is efficient in terms of silver and gold eagle production to meet, industry demand and ongoing demand. And so what happened was they slipped that in, and the peak of Silver Eagle sales and Gold Eagle sales really kind of happened 2015, because you had all these bullion bulls who were buying dollar cost averaging as the spot price was lowering. And 2015, a huge amount of Silver Eagles got sold. But in the last few years, it's become dysfunctional, inefficient because of multiple reasons. I would say, one of the reasons that always gets pointed to is the private mints that have contracts with U.S. Mint. They basically, they want to keep those contracts because that's always business for them, no matter what's happening with the market, because Silver Eagles are consistently purchased. But I think they can also make a lot of money privately minting their own rounds right now. Like you said, rounds are being sold $5 a clip over spot and retail level. So you can bet those mints are making good money. And so it's this weird situation where, and I heard Janet Yellen just today, someone sent me the video. A year ago, she was on the U.S. Mint's website talking about the Silver and Gold Eagle program and how it's brought in $30 billion to the U.S. Mint, et cetera, et cetera. And then she patronized anybody who's been buying bullion, Silver Eagles and Gold Eagles by more or less belittling them into collectors, basically saying, oh, they're beautiful coins and they're nice collector coins and collector. And it's like,
the program is relic, right?
Yeah, no, it's not even that. The program is called the Bullion Coin Program, not the Collector Coin Program. Okay, it is supposed to be somewhat near spot, and it's supposed to actually be available when people want it. Okay, and there she is, convoluting all these things together, right? So the U.S. Mint and Janet Yellen, I'm sure, are fine with getting away with selling 20 million Silver Eagles and however many amounts of Gold Eagles, because they're making enough profit off of them right now to cover the costs that are associated with creating the circulating coupon nickel coins, like the pennies, the nickels, the dimes, the quarters in your pocket. The U.S. Mint loses on making those, but they make up for it by selling gold and Silver Eagles at these exorbitant seigniorage fees, right? And so as long as they're able to cover their own backside and say, look, U.S. Mint's doing okay, it's not hemorrhaging money, nobody can say that we're a terrible government agency. That's all they need. They've already rigged the market in 2010, so they don't have to actually meet public demand. It's good enough. So they're losing market share because of that reason. Silver Eagles are going and they're exploding in premium, and yes, dealers are buying them back at exorbitant premiums. And for people who bought them when premiums were actually relatively reasonable, like 219 at the end of 2019, you could get them at 219 over spot, 229 over spot. What that meant was that wholesalers and retail dealers were making 20 to 30 cents between the two per coin. Okay, that's not making money. That's actually like a loss leader. And the only reason people were doing that was to protect their market share, right? They would go down to that level to make sure they weren't losing customer base. And now, obviously, it's gone the other way. And how long will it last? I mean, it's going to last a long time in terms of, now that Janet Yellen thinks that it's a collector coin program, it means it's going to last for a long time. And then the other thing is we still don't have banks failing. We had the first part of the global financial crisis in 2008. We pressed time out, and we've been bailing out everything ever since. Well, I'm still waiting for the second half. The second half of that thing is going to be tremendous. And what you saw with Gold Eagles and Silver, there's going to be a J, I think, at some point. If you look at a chart, the 2008 peak in premiums, now we're going up now. But wait till the banks start. That's when it becomes absolute, like I said, the fear drive. It makes people, they'll pay through the eye if they're thinking they're going to lose everything. And so that is exactly the type of cocktail that's building.
Yeah, it's interesting. Nothing has broken yet. It's not like in 2008, nothing has broken yet. And still, premiums are exploding. So that's some very interesting insight. When something does break, I expect that probably the spot price of silver and also premiums are going to be moving up in a big way. Now, as far as premiums go, the other thing that seems to have exploding premiums on it right now is junk silver, the old 90% silver coins. And I can remember when I first started stacking back in around 2010, going to a local coin shop, and there's this old guy there. He's the owner of the store. He'd been in the business for 50 years. You know, he probably remembers when we were on a gold standard. And he told me, I was buying some silver dimes, I think, a little bag of silver dimes, some of the first stuff I bought. And he told me, he's like, oh yeah, you should keep buying those. Eventually every one of those coins is going to have a numismatic premium attached to it someday, because they haven't been making these things since 1964. And I mean, I'm glad that guy told me that, because a big part of my stack is junk silver, and I'm real glad to have that. Now we're seeing about a 60% premium over the spot price to get your hands on these old coins. And back then it was like you could buy them under spot sometimes. It was like the cheapest form of bullion you could get. So this is not a surprise to me, because it makes sense. You know, the supply is only shrinking. A lot of these coins have been melted down. I'd love to know what you think about junk silver. You know, how high do you think the premiums on that could go? Do you think they could exceed that of a silver eagle? And then the other part of this question, I'll give it to you like a two-part question, is seems to me that with the rising premium on junk silver specifically, there is a risk of good counterfeits coming into the market. I know for years on like wish.com and Alibaba, you've been able to see these fake junk silver coins. And I think in the past, they've kind of focused on like key date coins and things like that. But now, you know, if the premiums continue to move up, I wouldn't see there being a reason for counterfeiters to say, take real silver, make it into fake junk silver coins, and then, you know, benefit from the rising premiums. So what do you think about the threat of that? And, you know, what can stackers and the bullion industry do to protect against that as we enter this period of rising premiums?
So to answer the last question first, you know, the amount of threat in terms of Cupro, you know, that Chinese clads mainly, they all came out of China, really. And, you know, I was watching and monitoring that. And when it happened in 2012, 2013, I was on a video, you know, with one of my former colleagues, people I worked with, and we talked about it. And I talked even to, you know, the Secret Service, who's in charge of actually trying to stop it. But it's, you know, and this is an analogy it's not even close to as serious as this other analogy, but, you know, Chinese fentanyl coming to the United States, how are they stopping that? Good luck. It's coming through the mail. You know, it's the same thing with you know, these clad counterfeits that are coming into our country. Very hard to stop. So, and then how do you prevent yourself from getting, you know, involved with accidentally buying that? I mean, you have to be careful with who you're buying from. You have to know your counterparty, right? So if you're going to buy from a local dealer, or you're going to buy from a bullion dealer, you better make sure they know what they're doing. Right? If they're like a Johnny come lately, be careful, because they may not even know that they're selling you counterfeits. As well, there's other things out there. I mean, to do XRF scanning, to do, you know, there's different types of machines you can buy. So if you're someone who likes to buy and then confirm it later at your house, you can do that as well. But just be careful if you think you're going to be like slick and go out and buy off like Craigslist or Facebook or any of these places like Reddit. You know, I mean, that's if I was going to take people with counterfeit goods, I would take them at those sites, because that's where you would find people dumb enough to think that you can get gold or silver, you know, at spot or below. I mean, that's where you would go, and they probably, you know, they would take you and meet you in public, face to face, and they would take you there, and you know, and you have to be careful too, because you're showing up at a place where you're supposed to, you know, paying cash on the barrel. So the whole thing is very risky. And then the other idea is like, a lot of times people will pay with PayPal, and with PayPal there's tons of fraud. People will give you a check, it will bounce, or it will go in and then it'll be canceled 5 days later. I mean, that's the reason why bullion dealers have these weird rules when it comes to the way that you pay. It's because the payment needs to be irrevocable. You know, in case the spot price falls and people just want to walk away because they have no honor, and they don't want to pay for what they committed to buying, you have to have some retrieval, and otherwise you're the one that's going to end up holding the bag. So it's a risky thing, and I think the biggest counterfeit threats are, you know, the old silver eagles, the old 1800s Morgans. They make a lot of fake Morgans. I've never seen a really good, sophisticated 90% silver coin that's come out of China yet, but you know, it's possible. It could happen. So, you know, all those threats, they do exist. It's just a question of making sure you know who your counterparty is, and being confident in that they know what they're doing, and that they're selling you products that are the bona fide thing. And then on the 90% front, I mean, you're right. It's the premium now is it's even higher than it was in the 2008 global financial crisis. So it's similar to the Silver Eagle program situation. And there is a limited supply of 90% because they're not making any more. And I'm telling you, at the end of 2019, we learned about it, that dealers and refiners were selling 90% at spot, and refiners were melting them because they could make more on just melting them for the silver than they could selling them in the retail market. And so you had disappearances going on then. And obviously when the pandemic came around, there was a massive spike, and then it came and drew down to the beginning of 2021, but it's been climbing ever since. So yeah, it can go higher. Yes, it can, because of the combination of reasons we've talked about. The speed of the internet, the speed of communication, which is way higher now than it was in 2008. If you ever were on social media in 2008, it was not even close to sophisticated. You got smartphones. Yeah. I mean, the amount of, see, if you can get in someone's lizard brain very quickly, that's how you get them to buy instantaneously. And that's exactly what those things are designed to do. And that's why I'm saying people are not taking that into account. And the other thing is, like we talked about, the banks haven't even started failing yet. And if that starts to happen, good luck.
Yes, absolutely. Yeah. And I mean, that is probably coming here as the Fed continues to crank up rates. I've got one closing question for you. We've been doing a lot of serious stuff here, so this is just a little more fun. But and I'm going to put you on the spot, but what is James Anderson's favorite bullion product? Like, if you had to just pick one, not to do with, price or investing or anything, just, what's your favorite thing to stack up?
So that question is important because, I've not been buying that much of late, but I did buy a lot in the 2010s when spot prices were down. I bought even a lot during the 2008 global financial crisis. And so it really depends upon premium versus, the spot price and where the market is at. Overall, in the long term, I like Silver Eagles. I'd pay, 220, 230 over spot, no problem, even when spot was 1918, because I knew from my experience in 2008 that these days were coming. People thought I was crazy when I'd say we're going to see that again, but yeah, so here we are. And like I said, it could get worse. So Silver Eagles when the premiums were reasonable, Silver Maple Leafs when premiums were more reasonable. Now, at this day and age, I would go with bars. And anything that's closer to spot is probably the better bet. If you can get anything within a few bucks a spot, that's probably your best bet in terms of getting as many ounces as you possibly can that your fiat can acquire. And so I would suggest with these premiums, that the way they are, be shrewd about the way you go about buying and get the right products. Of course, don't buy 40% junk silver coins. Okay, just because they're lower priced. Those things have a terrible bid value. Okay, when you go back to sell them, you will know quickly that you bought the wrong product. You need to understand that what you want to buy is A, verifiable, understandable. It's very easy to trust. And B, when you go to sell it, but just make sure the ounces you're buying physically are known and well-trusted hallmarks and brands that people are going to want. Because at some point, either you or people that you maybe give it to later on, your children or, you pass down to, if they want to liquidate some portion of them, you want to make sure that the market's going to respect that on a bid price that's fair and equitable. So I suppose right now I would be looking at well-respected brands and hallmarks of bullion bars and rounds that I could get within a few bucks of spot price if possible. And so, recently, another thing too is anyone who's holding Silver Eagles, that opportunity to flip and arbitrage them, it exists as well. So that's something I recently did. I have Silver Eagles for the future because this thing could get crazier still. So but I did take advantage recently because you never know. When you see a gift horse in the mouth, and you're able to increase 500 ounces to say 700 ounces, you just kind of take it. But I'm keeping more because, if you think this is crazy, you've not seen anything yet. In a mania phase, it can get even crazier. And that's what I'm fully expecting. For as bad as silver has been in the 2010s, is as crazy and as good as it can get later 2020s.
Yeah, absolutely. Yeah, I mean, I kind of agree with you. At the end of the day, an ounce of silver is an ounce of silver. So if you've got a lot of Eagles, probably a good idea to at least, take some of those gains from the premiums off the table. But like you said, things could get a lot crazier. So the Eagles, still, it's kind of a balancing act. You want to hang on to those, but maybe take a little bit of your gains off the table now and get into something more like, the generic bars where the low premium silver still exists to some extent. I saw SD Bullion right now is having a sale on the COMEX size bars. So that's a very interesting phenomenon. I think these gigantic 1,000-ounce bars being sold by bullion dealers. And in the past, I don't think that that's something investors really would have looked at, retail investors. But hey, if it's the only low premium silver you can get, then that might be what we have to do. I know, the Wall Street Silver subreddit, they were buying those and slicing them up. You could buy slices of the COMEX bars, which I love that, because it's like you're really taking that off of the COMEX then. You got to recast that thing into a bar if you want to make it good for delivery again.
And one thing, we did see that in 2008, and just to let you know. When the
oh, really? Okay.
Right. Yeah, there was a push into 1,000-ounce bars because there's virtually nothing else, and the premiums were somewhat reasonable, but it's inefficient in the sense of for a retail dealer to sell those things, they're not homogeneous, meaning that they're not exactly 1,000 ounce perfect. And so when you sell them off, it's 40 ounces there, 40 ounces there. So you've got to be very exact so the exchange is proper and right in what you're telling people on the websites. So it's not as efficient as selling homogeneous products. So whether or not it's going to grow in the future, it probably will, because this market on the retail side, I think, is going to get even crazier. Whether or not it happens crazier real quickly or in a few years from now it gets crazier, like all the things we've discussed, this is going to continue. I think it's just a question of exactly how and when will it go into a crazier spike.
Yeah, absolutely. But it does seem like we are getting closer by the day to that event. So thank you very much, James, for joining us today to get this insight. We'll have to do it again sometimes. Before you go, why don't you let everybody know where they can check you out, where they can find your work and get some more information from you?
Great. So I'm James Anderson. I do a weekly Bullion update on SD Bullion's YouTube channel. So typically Friday afternoons, I'll do anywhere from like a 7, 8 to 15, 20-minute video, trying to recap more or less the news that I've aggregated throughout the week that are important to investors that are, physical precious metals investors typically. So the content is going to revolve around bullion related content, sometimes extremely focused on bullion. Sometimes we'll go a little bit out of the realm and talk about things like the bond stock market, et cetera, fiat currency markets, et cetera. But it's usually pretty related because bullion does encompass virtually everything that we're looking at right now. And so that's one way. And then if you're on Twitter, you can find my handle at James Henry And.
All right. Well, thanks a lot, James. I appreciate it. We'll get you on again for some more information. I really appreciated this conversation. And thank you to everybody who tuned in. Thanks for watching. Leave us a comment below to let us know what you think about all the topics that we covered in today's video. And with that being said, stay safe, everybody. Happy stacking. Smart Silver Stacker out.